Well, in business news, earnings season in the U.S. unofficially kicks off next week with Alcoa reporting on April the 11th. Africa 54 business correspondent Jill Malandrino in New York is joined by Steve Kalayjian of the Kalayjian Report for his take on what to expect for the second quarter.
Next week, the traditional start of earnings kicks off with Alcoa. Steve, let's get your expectations, because according to S&P Capital Intelligence Research, only 3 of 10 S&P 500 sectors are expected to beat X-energy. We're looking at a negative 3.6% growth rate.
Well, I think earnings going forward are going to be challenging for the markets. They're expecting, as you said, a decline in earnings from the prior quarter. So it's not looking good here for corporate earnings going forward.
Right. So global growth is clearly down across the board.
Correct.
Earnings expectations are low, but the market continues to hit new high after new high, even with oil being down.
Well, the market's being fueled by Fed intervention. Basically, when the Federal Reserve came out a few weeks ago and said that they were taking 2 interest rates off the table for 2016, that got everybody excited. Again, this whole move up was pretty much Fed intervention from the ECB, Bank of Japan, and our own Federal Reserve Central Bank, and also by short covering. And so it really wasn't fueled by any economic growth and or strong economic earnings.
Now, you've been trading for almost 30 years. When do you expect to see some volatility come back into the market, or potentially a sell-off? Because corrective action is a good thing for the market. Just going straight up isn't necessarily healthy.
No, I think, as an investor, you really have to know when to take money off the table, and you can't be complacent. I think, again, you're seeing the same pattern evolve exactly that happened in 2015. And I pretty much, back in April of May of last year, I called around the 18.1, 18.3 level for the market to top out, and then a decline down to 16.1, which we actually got to move down to 15,371. So I think the same scenario is going to pan out in April of May of this year. If I look at my technical work, looking at the exchange traded fund SPY, there are 4 gaps below the market, and a gap is when you have a close and then an opening from the prior day. So there are 4 gaps, and in my 30 years, all gaps get filled, and that's what I was basing my work on last year. And I have now 4 gaps, which should take the market down to the minimum 15,500 level.
In the Dow?
In the Dow Jones Industrial Average.
It's interesting that you're looking at the later May timeframe, because that coincides with the June Brexit, meaning that the UK is voting to potentially leave the European Union.
Yeah, I think that could be a catalyst. Also, there are, if earnings aren't coming in and as expected, and I think basically the market should really be going up based upon strong economic numbers and strong corporate earnings. But when you have so much central bank intervention, it's hard to fight, as they say, fight the Fed. But again, I think that eventually this is going to just pan out. And as an investor, I would be really scared being up at these levels. I mean, I think you take the money off the table and wait for better opportunities sometime in 2016. What
levels in the S&P 500 would you look to start buying again, should we get that corrective action?
Well, that 1802 level on the S&P is a big, 1810 is a big number. It doesn't mean it can't go lower,
right.
But I would look at that as a start. But again, that's a long way away here. I mean, we're at 2050 on the S&Ps, so that's over 240 points away. So that's a big number.
Okay, thank you very much, Steve.
Thank you.
For the Voice of America in New York, I'm Jill Malandrino.